Now, last week we covered Chapter 10, and I told you that Chapter 10 will only be focusing on the first half of the chapter, pretty much just the short-term notes payable and also other current liabilities. So for Chapter 10, you just have to review the first part of Chapter 10. Whatever I covered last week, that will be it. Okay, regarding human resource, the payroll, you can just skip that section. Okay, I'm going to come back to that if we have time, but if not, I'm going to skip it for final. Now we're moving on to Chapter 11, still on the chapter content of liabilities. Okay, liabilities are basically, again, debt that the company raised, either from the public, from other companies. Today we're talking about the liabilities, the debt, meaning the money that the company borrowed from others that has a lifetime for longer than a year. Okay, Chapter 10, we have been talking about liabilities that has a lifetime shorter than a year, a couple of months, half a year. Okay, Chapter 11, we're moving on to different types of liabilities that has a longer lifetime. So specifically, we'll be going over journal transactions for long-term notes, for mortgage payables, and then a pretty heavy part of this chapter is on bonds. Okay, so we have long-term notes, mortgage payables, and bonds. There are various different situations on how to journalize bonds transactions. What are different cases? Breaks down to 3 main cases. Okay, so again, the focus for each and every chapter, you have to know what are the new journal entries, new accounts, debit credit side, how is it represented on statements. Okay, for each and every chapter, this is always the core. What are the new accounts, new journal entries, how is it represented on statements? Let's take a look at the first section here, journal transactions for long-term notes payable. We've actually talked a little bit about this in Chapter 10. Remember the part that we talked about on current portion of long-term notes payable? That's basically the part of long-term notes that will be due immediately next year. Okay, so this was an exact example we covered last week, last Wednesday. If there's a long-term note that your company signed off that worth, you borrowed money, $20,000, say 2013. May 1st. And you borrow this money, sign off on notes, note certificate. Basically, this note has a lifetime for 4 years. So sometimes these notes will be paid by installments, meaning that we're not just paying off the money altogether 4 years from now, but we're breaking it into little portions, $5,000 as time goes by. Okay, so the first year, at the end of the first year, you'll be paying a part, 1/4 of the $20,000, $5,000 after the first year, another $5,000 after the second year, another $5,000 after the third year, and then the very last year also the additional $5,000. Okay, so this $5,000 that immediately will be due the following year, in a sense, it's not a long-term notes payable because it only has a lifetime of 1 year. Okay, so that part, if this note, the characteristic of this notes payable is paid by installments, a certain amount equal every single year, then the part that will be due immediately next year, we reclassify it into current portion of long-term notes payable. Okay, so meaning this is actually a short-term liability account. So there's $20,000 here, and then immediately we reclassify a part into short-term notes payable. So both of the T accounts will look like this. So this happens May 1st. You first borrow the money, and then you reclassify it into current portion of long-term notes payable. Okay, so this is not saying that your liability reduces $5,000. We're just separating the part into the part that will immediately be due next year, and the part that will be due the second year, the third year, and the fourth year. Right? So this part is a review. We covered this in Chapter 10, just the reclassification part. And where we're continuing on this journal entry is after the first year, or at year end, what do we do with this notes payable? So remember, for each and every note, what does it come together with? Interest, right? So for each and every note, as long as it's called notes payable, the difference between notes and accounts payable is that there's definitely interest accumulated along with this principal amount that you borrowed from others. Okay, so this note is signed off May 1st. What would happen December 31st? It would accrue interest, and specifically for how many months? May to December 31st, and if we count the number of months, that will be 7 or 8 or 9. Should be 8, right? Because we're just missing January, February, March, April, right? So 12 months minus 4. We start from May 1st. May 1st is the beginning of this month, so the entire May counts. December 31st also counts, so altogether there's 8 months of interest. So tell me, how do we calculate interest here? Do we calculate interest based on 5,000 or 20,000? 20 because that's the principal amount, right? Currently, there's still $20,000 that's due, so by the end of this year, it will be $20,000 times the interest rate, it's given 6%, times 8 over 12. So at the end of the year, if we want to accrue interest, what do we debit? Just like short-term notes, what do we debit? Come on, interest. If you want to accrue interest at the end of the year, which means your company borrowed money, so you owe other parties interest, how do we recognize this? Interest expense, very good. It's the debit side. What about credit? Interest payable. The reason why it's payable is because whatever this dollar amount is, the interest amount, the reason why it's payable is because this note is not due, not even the part that will be due a year. The part that will be due a year will be due next year's May 1st. But when it reaches the end of the year, what we're trying to do is just recognize how much interest has been accumulated on this note. Okay, so this is not paying cash yet. We're paying cash later on after a year. Remember, a short portion will be due. $5,000 is due here, plus interest is also due for that year. Okay, so a little portion of the note will be paid off, and also a little portion of interest will be paid off.